Crypto Hotep here with another investing video. We are on week 36 of the family portfolio and dividends tracker. Now, if you're unfamiliar with these videos, feel free to go to the channel, go to week number 1, and there you will find my methodology, the reason behind why I'm doing this, and how this whole situation came about. Basically, in a quick synopsis, I gave my family a set of stocks and dividend stocks alike to choose from based on if they only had $1 left, where would they put their money into? They select the stocks that correlated to themselves, and I used M1 Finance as our broker of choice because of their technology. With M1 Finance, you can create this big portfolio that we call the family portfolio, and every family member has his or her own stocks allocated in a mini portfolio solely dedicated to them. And you'll see what I'm talking about shortly here. And as always, guys, if you like these videos, feel free to like, subscribe, comment, and let me know what you think. And then every week, what we do is we review our portfolio. We talk about balances. We talk about dividend activity. We talk about the markets and what's been going on. And most importantly, I think we talk about the emotions of the market and how that's driving our decisions. So as I mentioned, if you like these videos, feel free to like, subscribe, comment, let me know what you think. But by no means is this financial advice. Please do your own due diligence when investing into stocks or anything volatile. With that being said, we'll jump in. Before we go to week 36, we look at week 35 very quickly. So week 35 had us recording a balance of 1448.67 with a money weighted rate of return year to date of 28.07% and dividends earned of $8.91. This week we did go down. So we went down. Money weighted rate of return year to date was 24.14%, and dividends earned was $9.83, with a balance bringing us to $1428.12, so $1,428.12. So what has actually been going on here since last week? Well, since last week, we had a lot of dividend activity. Now, we haven't had any deposits because if you do follow the channel in these videos, we only make deposits every 2 weeks or so. Okay. And we usually stick to that methodology. And the reason is I want to showcase kind of the humble beginnings of where we started out at, and also to showcase that you can build wealth and you don't need a lot of money, especially with this day and age. Brokers like M1 Finance make it really easy to invest now, and you don't need to have $1,000 to start off with, or even $500 to start off with. You can just start very minimally and build that position up. So with that being said, we'll look into our dividend activity. So between this and this weekend last, we had dividend activity from American Express, Deere, Apple, Costco, Procter & Gamble, Colgate, and O Realty. And if you're unfamiliar with the dividend piece, dividends are basically a payment paid out by companies for holding their stock. There's a lot more that can go into it, but just to give you a general viewpoint of what dividends are, that's basically what it comes down to. And the reason we like to look at dividend stocks, or why I like to look at dividend stocks, is because of the passive income. It's kind of like the Warren Buffett saying of making money while you sleep. That's literally what you can do with dividend stocks. And so, and another thing is that more than likely, these stocks are, or these dividend stocks are well established companies that have been around for a while, and they can afford to actually pay a dividend. So I know these are small amounts here. These are pennies, not even a quarter yet. But as I always say, we're not worried about the actual dollar amount of the dividends. We're just worried about the fact that we keep getting dividends and we keep building our positions. Because the bigger position we have in American Express, for instance, the bigger that dividend payout will be, and it'll be far surpassing that 4 cents. Okay. So a lot of dividend activity between this and last week, so that's very good. Um, and let's look at and let's review those portfolios. So as always, we go bottom to top, and at the bottom again this week is my wife's stocks. So if you've been following, you know that the Achilles heel of my wife's portfolio is none other than Celsius. Celsius has drawn down year to date. Let me make sure this is year to date. Yes, year to date of about 73%, and it still is at the key level where Celsius is currently. I think Celsius is undervalued right now based on its chart position. It did not have very good earnings though. Their last earnings weren't very good. Kind of slow. They didn't hit earnings per share. I don't believe they hit the revenue either. But I told my wife that we want to wait until end of the year to see how everything looks from Celsius from a business standpoint. I think they just had a kind of a bad quarter there, so we're looking more to what the business did the whole year and getting a better picture of that before we do anything drastic, with this stock here. Year to date, money weighted rate of return down 32%, 32.5%. Dividends earned about 31 cents. Pepsi has been sliding as of late, down over 7% here. Google up over 16%, and then Tesla up over close to 24% there. Okay, so as of right now, the Achilles heel is Celsius, but I want to look at Celsius from a business standpoint towards the end of the year and see that, or get that total and that full picture before we do any adjustments. And even then, I don't think I'm really going to adjust anything too drastic with our portfolio. I may just bring down the percentage of allocation down just a little bit. Let's look at our middle stocks. So our middle stocks, we have year to date weighted rate of return 16.62%, so very good, and 34 cents dividends earned. Okay, so the middle stock, this is our kind of the steady earner, the steady earner portfolio. So it's not rate of return that's going to be like 50%, 60%, but it's also not going to provide negative returns. It's kind of middle of the field, and it's a very good portfolio I've seen, where it hasn't had really big drawdowns. It hasn't had over the moon rate of returns. It's kind of, like I said, in that middle. And the reason being is there's a lot of good established companies here: Amazon, Target, Starbucks, Costco, Nintendo, Tesla. Mostly everything's in the green. Nintendo, always that outlier, as we mentioned before, usually down a little bit less than 1%, which it is, 0.81%, but everything else is looking beautiful for our middle child's stocks. Let's look at the youngest. Youngest is up over 37.5%, with dividends earned of 36 cents. Market gain of over $23 here. So Nintendo, again, that's down a little bit over 1%, almost 2% here for Nintendo. Tesla up over 100%. We all know, if you've been following, our youngest has held Tesla ever since we started these videos. This was one of those stocks, as I mentioned before, gave the list to my family with the stocks that they wanted to choose from, and our youngest selected Tesla right off the bat, and has held and bought more through the ups and downs and reaping the benefits right now. Starbucks up over 27%, and Apple up over 29%. And let's go to our oldest. Our oldest up over market gain of $53.90, dividends earned of over $1, right? So over $1.03 here. So we're getting up on the dividends. I love to see that. So very good core portfolio. Sometimes you only need 4 or 5 stocks. You don't need a plethora of stocks. Sometimes you only need 4 heavy hitters and consistent hitters, and you'll make your mark. So Apple, Tesla, Costco, McDonald's, all in the green. And nothing really to say about this. This has been a very consistent portfolio. Sometimes it's been down, but most of the time it's rode the waves. And then last but not least, mine. Now, unlike our oldest, I do have a lot of stocks and I've broken them down in sections and sectors, I should say. So money weighted rate of return year to date, or 16.5%, right on the nose. And then dividends earned $7.79. So with me, I've broken these down. If you follow me, I've broken all of my stocks down. I have about 50 holdings. It's straight even number there, 50. And I've broken them down in each sectors with what they apply to, right? So here, the biggest one with the biggest gains and the biggest risk is the growth in the meme stocks. So the growth in the meme stocks, I have Palantir, MicroStrategy, Tesla, CrowdStrike, and DTE. As you can see, most of these, not only are they in the green, but they're double-digit rates of return. But again, that holds a lot more risk as well. So I don't allocate that a lot into my portfolio. And when I say allocate, I mean here with M1 Finance, you can allocate a certain percentage of money to go to a specific basket of stocks here. So I only have 5% coming here into these stocks. So what that means is if I were to invest $100 and spread it across my different sectors here, then $20 would go to technology, $15 would go to consumer staples, so forth and so on. And then last but not least, $5 would go to the growth in meme stocks. And that's the kind of the beauty of M1 Finance. They take the guess out of that, and it's more of a cruise control type of investment strategy there. I think real estate has been doing well in my sector. It's up over 20%, with public storage and federal realty kind of leading the way here. O is a dividend machine. I'm not really worried about O. I would hold and buy O till probably the end of time, if I'm being honest. And let's look at finance as well, because finance right now is above 20. It's about 24.3% year-to-date return, which is fantastic. Everything's in the green. And under the finance piece, we have Aflac, the insurance company, American Express, very good, Moody's, which is also very good, and then Visa, which we're doing fantastic numbers. Visa is it's a cash cow. If you want to get a good dividend stock, Visa is a very, very good dividend finance stock. And last but not least, let's take a look at we'll look at industrials. We always look at technology. Technology always gets the spotlight. So let's look at industrials. Industrials, they're mostly energy related companies, or kind of like construction work type of companies. So, Caterpillar's in there, Deere and Company, Waste Management Group, Union Pacific, and ExxonMobil. ExxonMobil, very good dividend stock. Cintas, very good dividend stock as well. Duke Energy falls into that realm here. So this has been doing fantastic as well. Up over 13, the sector itself up over 13.71% here. Okay. And with that being said, guys, before we end today, we're going to look at one thing that really struck my interest here. So as you guys know, Warren Buffett is one of my favorite investors. I read about him, kind of follow what he's doing, and his whole methodology and how he started investing. And I really take everything he says very closely, because he has proven himself. The numbers are real. So he's been doing a lot of selling in his portfolio and a lot of sitting on cash. So right now he has accumulated the most cash Berkshire has ever had, which is his firm. And one thing that caught my eye was he actually started investing in a Domino's Pizza. And Domino's Pizza is a dividend stock as well. So the 13F filing, which is a filing that is public knowledge, So, every kind of investment firm and those type of things, they have to file the 13F, and then this 13F filing shows the buys, the sells of securities, i.e. stocks, in their portfolio. So usually I like to look at Warren Buffett to see what's been going on. And the major news was him adding Domino's Pizza, making up only about 0.21% of the portfolio, but buying over, a million shares of Domino's Pizza. He also added Pool Corp as well, which I'm not very familiar with. I can also look into that, but very interesting indeed. He did trim, he has been trimming Bank of America and also Apple a lot. So that's also been going on here. And his total portfolio comprises of 40 stocks. So something to keep in mind here. But as always, guys, thank you for taking time to listen. If you made it all the way to the end of this video. And again, week 36. The balance is 14.2812. Money weighted rate of return year to date is over 24%. Dividends earned, it's $9.83 for the family portfolio. If this video is helpful at all for you, feel free to like, subscribe, comment, let me know what you think. And as always, thank you and happy investing.